Добрый день, уважаемые коллеги.
Good afternoon, dear colleagues, ladies and gentlemen. Welcome to the session which is devoted to bank regulation and the way it is going to look like in the future. My name is Alexey Labanov. I'm in charge of the development and the introduction of bank risk management technologies in the Bank of Russia, including international experience. Let me introduce my colleagues and the panelists there who would be the speakers for today. Here in the studios today we have Maxim Kondratenko, member of the board and head of risk management department of VTB Bank, and online with us is Dirk Hollander, senior partner of the consulting company of Germany, and Rashid Lassuet, global head of financial engineering and risk at Bloomberg. And for a start, perhaps I should recall here, and it's a good moment for that today, is to recall more or less the decision taken by the Basel Committee in November of last year to put a hard stop, as it was mentioned in the press release, a hard stop to any further work on the standards in the Basel standards, in the Basel package, and it's the end of more or less a 10-year effort to improve the banking regulation and the banking system across the world. And perhaps here I would take some philosophical view of the situation, and maybe we can show some slides there as well. If we recall the categories of philosophy in dialectics, one of those categories is the category of development, which is described as a spiral. If you take Hegel dialectics, it has 3 stages. Any development goes through those 3 stages of development upwards. You start with a thesis which develops and matures. It comes to negation, and then it comes to your self-negation to give birth to another thesis, which may be close to the original one, but will be different in terms of quality or the understanding. And now, if you take the same dialectical approach to the development of bank regulation, perhaps you can see the next slide, we see a very interesting picture of the development of regulatory thinking and its implementation standards. In the 80s of last year, we saw Basel I, which was based on the ideas of standards of regulation and a universal approach to all banks. This was unanimously supported back then, and it actually kept going until the mid-90s. The negation was more or less moving to internal models by banks for those models to be recognized for regulatory purposes, especially for the capital adequacy ratios purposes. It all continued until about the noughties and culminated in the adoption of Basel II and the capital adequacy ratios, which was the peak of the regulatory thinking back then. The global financial crisis more or less disrupted this movement and gave birth, as a reaction, to counter-cyclical regulation, which was focused on more or less covering those gaps that were revealed during the crisis as fast as possible. And we know that from Basel III, which was adopted in the first few years after the end of the global financial crisis. Then, of course, we took a sober look at what was going on, and some people call it Basel 3.5 or even Basel IV, and you can characterize this stage as the use of internal models, but more or less standardized and unified, and with some limited capacity of the banks to use their own judgment and internal assessments to regulate and to calculate their capital adequacy ratios. Looking at this spiral or tree, you might ask yourself a question: what is going to be the next stage of global regulation effort? If we follow this dialectical model, maybe our speakers today would be able to identify those future trends in modern regulation, bank regulation, maybe nationally or internationally, and project those trends into the future, so that my colleagues who are online with us to be able to participate, I'm talking about the audience, to participate in our session. I would offer a very short survey or poll, if you like. Maybe you can vote for those questions that we would summarize the outcome of that voting in the end of our session. The question is, what would be the key challenge for the Russian banks in the area of regulation in the coming few years? Several options there. Maybe the full implementation of Basel III in Russia, limiting the risk concentration, or maybe it would be the risk of non-core assets, or maybe those would be the climate change risks. By the way, we had just a heavy thunderstorm in Moscow today. That might be another risk. Or maybe those are the operational risks, because they are now reaching a new level of regulatory focus and attention. Please, colleagues, do vote for the options provided to you. But let me open the discussion today with a question to Derek, as an expert in international regulation, as to a person who has been engaged in such discussions and some contemplations for many years now. Now, if you take the Basel III standards, which was approved by the Basel Committee for Banking Supervision a few years back, but it is far from being implemented, even in the countries who are members to the Basel Committee. But it is clear now that the future agenda of regulators already changed a lot. We do witness an international crisis of the pandemic. It's rather a natural risk that we are facing today, and we are trying to quench this crisis with a lot of injections of money and liquidity in many countries of the world. And then traditional bank risks like liquidity risk or credit risk, and to a lesser extent also market risks, are less pronounced, I would say, for the major banks and their clients, because they are distracted otherwise. I wonder if regulation that was created in the last 10 years with the effort of the whole global banking community under the leadership of the Basel Committee and the Financial Stability Board of the G20, do you think this is not relevant anymore? Or maybe it was already limiting significantly the global development of banks. So it is rather a nuisance than an incentive. But do you think that the new risks that we have faced in recent times, like cybercrime or the pandemic or climate change, do you think they would be dominating on the agenda of bank regulators?
Yeah, thank you for that question. A very broad but a very important one, likewise. And let me share a couple of thoughts. And I think you were driving a bit at, and there is a discussion in Western countries as well, whether or not Basel the mission has been accomplished or not. So sort of as you put it, a nuisance or a bug or a feature. Maybe to the question, what has been accomplished? Just think back about a year's time ago. In April 2020, there was a massive liquidity shortage. And we were running on the brink of sort of being illiquid here. And like in the following months, we had massive market fluctuations and market prices and ensuing market risk. And now we're having credit risk on the rise again as such. And if I look at that and would think of this situation with the pandemic happening in 2006, 2007, with all the massive changes that have been happening there, then probably the banks would have been hit at a very vulnerable spot. I mean, what has been achieved in the past 10, 12 years? Balance sheets have become more robust. Capital buffers have been increased. So the fact that at the very least the Western European banks went and sailed through the crisis was also a bit of a function of them being sort of creating a bit of a fortress balance sheet and a very good capital situation. So in one way, a mission has been accomplished by Basel 2, 3, and 4, if you like, by making the banking sector more resilient. But you're absolutely right. Putting more security and safety nets into the banking sector costs money. So the productivity of the European banking sector is way below the US, American peers, way below Russian banks. So it costs a lot of money. It makes managing a bank super complex because you're running in a constraint box as such, and you feel sometimes to being a bit patronized by regulators in the sense of very technical, very complex ratios that have to be ticked the boxes all over on sort of old time risks as such, and not so much looking into what could happening in the future. So what do I think is, have we become a bit too super technical and a bit too much focusing on Pillar 1 in the Basel requirements? Yes, indeed we have. Have we lost a bit over that process of, I tend to call it good housekeeping, hygiene factors. I mean, we had to clean up the banking sector in 2006, 2007. That there was a problem that has happened. Is that sufficient now for the future to deal with all the types of risks that you were mentioning, Alexei, like cyber risk, fraud is a big problem, the whole ESG topic and what have you? Certainly not, that will not be sufficient. Maybe it would be good if we now would be focusing a bit away from the backward looking box ticking exercise of the Pillar 1 type of regulation type of things, and more focus on what was originally thought about in your ICAP, ILAP, Pillar 2 type of regulatory incentives, making sure that you take into consideration what is kind of putting your business model or your operating model at risk. And that would be nothing but sort of dealing with these types of sort of, call it volatilities that we are seeing today. Would that be important? Yes, and it's getting even more important by the day. I mean, before we were put online, Rashid and I were talking about the latest disasters that we saw, Greensill, Wirecard, and what have you, all these type of things would have never been captured by a simple sort of another constraint box, but it means simply that we as an call it as an industry, but regulators and bankers alike need to be sort of taking a step back, become maybe a less technical about Pillar 1 type of topics, and shift the focus towards forward-looking, call it scenarios, call it discussions as such. So yes, indeed, and I think everybody's realizing that in the light of all the accidents that have been happening. And to your second question, do we think that the avalanche of Pillar 1 regulation is more or less over, the peak has reached, and will there be now other regulations coming up? We see a lot of papers all about the type of risks that you mentioned. So there is indeed lots of discussions happening. However, what we think is it's not going to be as it was in sort of after the great financial crisis, that there will be calculation after calculation after calculation, or KPI coming in, but rather, or hopefully, a bit more a comprehensive approach towards taking these type of things into consideration, and sort of the Pillar 2 framework would give a perfect opportunity or vehicle to do so. But indeed, we do see the banking regulatory bodies moving towards non-financial risk management, and you've mentioned them all. Add to it, in particular in the UK, conduct risk and what have you. So there's definitely a shift in focus. Does it mean it was useless what we did in the past? No, it was hygiene factor, good housekeeping, but it's not sufficient. It needs to be further developed. So maybe a few thoughts from my side on that one.
Спасибо большое, Дирк. Из того, что я услышал,
Well, thank you, Dirk. From what I heard, the challenges that are of global nature, I would say,
было нацелено регулирование
indeed are relevant to all of us, and those are further complicated by also the challenges that the European banking sector is facing, which by the year 2027 will have to go through some housekeeping and cleaning to get ready to a new era, I would say, where the key role would be played by some scenario-based analysis rather than
и, безусловно, не финансовый риск.
looking backwards. And of course, non-financial risks will be managed in this way. Maxim, in your opinion, as a practicing banker and risk manager in the second largest Russian banking group, what do you think about all of this?
Подводя итоги Базеля 3 и заглядывая...
Well, summing up what Basel III provided us with and looking forward, indeed it's a good question to discuss and an interesting one to think about the future, but also to look back at the foundations that we laid down in the past so that we could be confident in our future. Well, all those risks, climate change, the pandemic, cybercrime, they are, of course, more prominent and do impact our economies and the financial system. However, does this mean that in bank regulation we need to change something? I think yes. Does this mean that such changes should be fundamental in their nature? I don't think so. The thing is that risk management requires a very well-balanced approach. We do appreciate some relevant trends and some, hypes there, but you cannot forget about the minimum standards. Operational risks, market risks are all those fundamentals that cannot be left without any systematic or professional attention, because otherwise you are facing some catastrophic implications, and the very institution that you are trying to supervise and regulate would disappear then if it is in breach of those requirements. Of course, all those new and novel factors that we discussed, I don't know, the climate change, cybercrime, the pandemic, of course they should be taken into account by the banks as part of their traditional risk management practices. For example, getting protected against cybercrime. It is very much in line with the operational risk management practices, in particular the managing your IT risks. And of course, you do spend some money and capital on the protection against such risks. But take the pandemic, for example. Undoubtedly, this is a situation of stress. This is a very new situation. However, I do not think that such a scenario of the pandemic has ever been contemplated by the banks in their stress testing scenarios. But using these stress testing scenarios to ensure the continuity of business, like BCP, for example, of course, they are projecting a higher impact on the balance sheet of banks, and they are testing against a higher impact against the loan portfolio of the banks and the bank's borrowers. And what would be that impact on them? And of course, the idea behind stress testing is that going through such a stress tests, banks should have enough capital to withstand, to protect the interests of the depositors and other stakeholders.
Что в результате вот этой практики обогащенной безусловно,
experience of the pandemic may enrich the banks with some new ideas about stress testing. But the process of stress testing is also very important, and even more important, I think, because the system of stress testing is used by the banks to plan and target the capital bases, and more or less provides the overall resilience to the banking system, rather than any focused regulation when you only plan to try to regulate the implications of the pandemic. Other risks, say the climate changes and the climate risks, especially if you think about any restrictions that might be imposed on the so-called brown economies compared to the green economies. Those, of course, need to be taken into account when you are assessing the business models of the borrowers from those brown economies or brown sectors. But of course, it is, we always had in mind the possibility of new disruptive technologies to emerge that would make sectors to go away, or natural disasters or sanctions. All those were in the back of our minds when we more or less developed our stress testing scenarios, or when we tried to manage the key risks of our banks. On the other hand, however,
Вот это сейчас представляется действительно очень полезно и
it is quite useful today to analyze and to manage traditional risks through the prism of this conceptual triad, the perimeter, the counter, the ESG risks, and the cybercrime risks. So this is more or less like your cognitive framework that would help you not to lose or to miss any new sources of risks, but also would help you demonstrate new and sometimes not evident correlations between risks. It would be useful, for example, to manage credit risks through the credit process contour or perimeter, that is, through your operational risks attitude. Same can be said about the other elements of the triad. Say, ESG is a good example of how various risks interact: operational risks, reputational risks, and credit risks. And when you take them within the ESG framework, then of course your analysis is much more granular. Now, regarding Basel III, of course, the current requirements of that standard are focused on managing key financial risks, but those also serve as the basis to implement those counter-cyclical policies and measures that we are using today during the pandemic. And thanks to the Bank of Russia,
наша страна, она, по сути, здесь впереди планеты.
This country is perhaps leading in some aspects, and we, thanks to such regulation, thanks to the fact that the regulation was adjusted quite early, we were able to more or less upgrade to Basel III even ahead of some of our European colleagues, and that is the opportunity provided by the Bank of Russia, and that opportunity is open to us since 2020, although in Europe the expected deadline of such transition is 2023. So we do have the framework, the basis in place now, the fundamentals in place, and banks now are able, through risk management, through their better efficiency at risk management, through their internal systems create some competitive advantages to their institutions, depending on the maturity of their risk management techniques. Thank you, Maxim. And to me, as to a risk manager with 20 years of experience, it's comes as a pleasant surprise that we are going to take the traditional risks in mind as well and take into account, but we would not have this gap between the traditional practices and the new practices. We don't expect that. Thank you for your complimenting and for praising our work. Thank you very much.
Well, but that's true. Rashid, you're a financial engineer with a great track record and with a lot of background internationally. What do you see in this turn of a century, so to speak, moving from the post-crisis regulation of 2008 into a new reality that could be drastically new, or maybe it's something familiar, but with a new twist? You, as someone who represents the company with the right tools, how does it look like to you?
So first, I think the one thing that is important to recognize is the fact that all of the regulation we had that came out of the global financial crisis has been a massive step towards the right direction. We addressed a number of things. The regulators addressed a number of problems that were there around transparency, typically transparency for derivatives. The ability to see transaction being public and being made public to regulators, to see accumulation of position, concentration of risk. All the specific work done around the establishment of standard approaches across the board, which are all sensitivity based. Typically the SIM, the ISDA SIM for the initial margin, the FRTB standard approach, the SSECR for the counterparty risk, and one has to see the opportunity that at least the delay that the pandemic provided as an opportunity for the banks to take a bit more time to get ready for the implementation of FRTB as such, and make sure that they could reprioritize resources where it was necessary. One thing that also is important is you could see that there is a great benefit in trying to standardize things. Typically now we have a set of standard ways to describe sensitivities, which are those CRIF files. CRIF, which is the ISDA format that is also going to be used for not only for the initial margin, but for FRTB and for the SSECR, which makes now numbers comparable across banks, because the way the standards are designed is very restrictive, okay, and extremely well balanced. One thing that is important to look into is how, okay, remember the FRTB model is a capital model, okay, and it is not a volatility model. And what we could see is that after the introduction of the stress VaR in 2008, 2007, and FRTB now moving into stress expected shortfall for internal models, and the standardized approach will be used as a floor to the capital binding calculation. We have done that without any volatility model at all. And the interesting part is, if you look at the massive bout of volatility we've seen in the market in March, April, you can also see that the standard approach type of model, typically the SIM model, did work pretty well. So there was no so the model, which had a bunch of sensitivities to compute against it for volatility risk, for rate risk, and for a number of other risks, held pretty well. So when now looking at the new financial risk, okay, this is the way we see it is it's an add-on to an already strong framework but this is changing the way we should all look at risk, and in the concept of managing risk and not measuring risk only. Okay, and we could see with the pandemic, with the COVID, that was one of those black swans, unexpected. The last time we had one of that nature was 100 years ago. So it's kind of very simple for people to forget that things that happened long time ago cannot really happen back. Okay, but the reality, and we got a very good wake-up call for that, is that we do not assess, or we do not really have an active view or an active management or an active supervision of those risks. Okay, we don't have models today that are running which looks at the next pandemic or the next time a virus is going to come out and see how it could translate, how it could become either a localized problem, which is less of a problem, or if it has chances to become a global pandemic. And this is the same when we look at climate risk and cyber risk. It's the kind of risks that are not always on the radar, at least not as much as when we look at risk management, for market risk, for credit risk, and for the likes, but that have massive consequences. Look at climate risk; it's a good example. And you look at what happened with recently. We had the Miami building that collapsed. Yeah, rising sea levels is a clear risk factor that has been known from meteorologists that can affect Miami as a city. And interestingly enough, when you look at some research paper from academics looked at buildings, looking at satellite images that would be basically sinking in the ground, and they found a few years ago that this same building that collapsed was basically sinking in the ground 2 millimeters per year. Okay. So there was signs, okay, and we don't look at those signs. So when you start looking at this, you have physical risk, which the banks are also subject to, and you have investment risk, which is also another part of the risk that the banks are subject to. And the difficulty now with this new risk is you're going to need to find a unifying framework that looks at tools that are not always in our toolkit. Typically, now you need to look at how you translate climate events, typically into macro and micro level portfolios. So macro risk and micro level portfolios, or how it basically goes down to the physical assets. Because banks have also real estate businesses, they have corporate businesses, and we all know that basically anything that will affect companies due to climate risk will translate into credit risk. Mm-hmm. So there is a complete interesting new framework now, and Dirk mentioned it earlier, that you need to look beyond just the traditional way we had to measure risk. And I think if you do not do that, we're going to have more of these problems, and we're going to be less prepared for handling them.
Thank you so much, Rashid. Now, these are some really insightful hints into what we're seeing today. Yes, non-financial risks are on the front burner. Some of these risks used to be considered to be exotic, but they could lead to the volatility, and there are new models and the old models to dampen the risk for the banks still work, and it's good. But yes, definitely there are black swans, and it's really good that we could work together to predict those black swans using the very subtle signals. And if we can do that, that black swan will not be a black swan anymore. Now let's go to the global issues that affect our banks. Russian banks traditionally used to get net interest income as the main source of their business, because the level of interest rates used to be always higher than in the West. And there is high concentration of loans to several industries and to some major corporates. And this is why diversification of the credit risk would naturally lead to lower net interest income. That's an inevitable factor why these banks are now engaged in tough competition for a non-interest income. That's a new trend for the Russian market, and some of the major national financial institutions have built big ecosystems around them. And the larger exposures limit by Basel could push these banks to maximize non-interest income, including from non-bank activities. And I've got a question to Maxim. Out of these two risks, the concentration risk and the mix of new risks that the banks assume as they tread into unknown terrain, into uncharted waters, which of them would be the bigger risk? And if it's hard for you to make the choice, how can we regulate both? Or maybe we should focus on either of them.
Давайте, наверное, для широкой аудитории.
Well, for a large audience, I need to clarify something.
Базельского
So what about this Basel regulation
связанного с лимитом концентрации?
related to concentration limit?
По сути, это регулирование, которое
These larger exposures limit. Again, that would help you to lower concentration in the credit portfolio of the banks. That's a 25% cap.
Банка 15% для глобальной системы.
15% for systemically important banks.
И кроме того, требования о
There is also a requirement on
отчетности в адрес
more disclosure submitted to the regulator if your exposure, total exposure, is more than 10%,
и отчетность по 20
and reporting on across 20 biggest borrowers, regardless of the amounts,
по сути,
regardless of the exposure. Again, that would set the rules for the groups of borrowers and the rules to calculate the credit risk. I think for a majority of our colleagues, for risk managers, it sounds really familiar.
уже много лет внедрено.
That's been introduced in practice
Российская банковская система
here in Russia for many years now, and many other countries around the world.
мало нового.
So there's little new, I would say.
Вряд ли эти ограничения могут быть
And these restrictions could hardly be a reason for an increasing trend in the banking sector to go into adjacent and non-banking services and products that are provided to the customers. As for the non-banking
то очевидно, что
business
в этой части
for the banks themselves, then regulators have to respond to these changes, and some sizable part of the assets will be made into
звучит вот при разработке
investments, will be shaped into as investments into adjacent industries. Yes, we often heard about this notion, immobilized assets, but I think this is not the right language. This is inappropriate to use this term.
непрофильные активы, которые
It's not just non-core, it's not only non-core assets that the banks could end up with. You know, this could be real estate that they could get as collateral that they had to sell, or that was handed over to them after a default on the loan. So these assets help the banks to provide a more comprehensive, more high-quality service, increasing loyalty, increasing their base, increasing the rate of return, and improving the resilience of their capital. So I don't want to challenge the idea overall, the idea that we need to regulate these transactions. Sure, we must do that. It is important, but nevertheless, these restrictions must take into account the efficacy of these provisions and should not constrain the banks in shaping the right customer journey. It's a very tough job for the regulator, and they need to rely on the best practices, but there's not that many best practices. Now, a good solution could be a dialogue as part of ICAP.
Например, ВТБ в рамках ВПОДК уже выделяет.
VTB, as part of its ICAP procedures, has identified certain risks, the real estate risk, the risk of investments in the capital of non-consolidated companies, and the risks related to the reliability of IT chains, and the step-in risk. The step-in risk where we'd have to, step in and help bail out our vendors or our partners. So I guess this is a good case study for the internal risk-based system. Thank you, Maxim. We'll definitely take into account your advice. We'll try to look at these risks through Pillar 2, what's known as SRAP in the West. So, what's your view on Russian banks? You worked in Russia a lot. You know about the issues of small banks and big banks. Over to you.
Yeah, thank you. And you saw me smiling and nodding to most or to all of Maxim's comments. You see me agreeing. Maybe I can answer your question in two steps. I'll give you some very quick introductory thoughts on what is happening or what has happened with regards to this adjacent services in the banking industry in the West and where we're standing there, and then what my thoughts on Russia would be. I mean, we see a very comparable situation in Europe as well, right? Banks don't earn enough net interest income, even worse than in Russia, given the low yield scenario. And what happened was basically, first and foremost, they tried to boost fees and commissions, first within the banking, so in order to prop up private banking or wealth management, what have you. And then banks moved over to offer near banking services that were somehow related to sort of your core banking activities, be it mortgages or what have you, be it then purveying services or even real estate objects. That has always been in Europe additional to the banking services. Always the core was the banking and then sort of some satellite offers around. As far as I know, there is no major European bank that has turned it upside on its head, saying, okay, let's be a true conglomerate like the conglomerate of the 80s or 70s, where all the different bits and pieces are more or less of a similar nature in terms of size and riskiness. So it's been always a core satellite approach in Western Europe. And even if you look at it, how the development currently goes, it's coming from the other side. You find more and more industrial firms like the big car makers or what have you, establishing banking branches to get, for instance, cheaper funding and what have you. So what's important, and that's what I'm trying to say, is not only in Russia, but always and in every country, Western Europe, the US as well, we believe, or I believe, that it's regulators and bank managers have to look at the overall riskiness of the position. There is not the one risk that should be put in focus and the other risk that maybe can be disregarded, because as we all know, the sort of money flows where there is least restriction. So in that way, then there always needs to be a balanced approach to it. I fully agree with Maxime with regards to concentration risk. There is a lot of regulation out there already. And if banks can manage around that in their own sort of remit, maybe that could also be an indication that the business or the operating model is not super efficiently put up. And maybe instead of trying to sidestep into other industries, or if you remember the early 2000 years, there was a way when some universal banks, they sidestepped their profitability issues by going into prop trading. And of course, we all know how that ended up. So maybe it makes sense if these original type of things are becoming a problem to look into one's business model. But maybe now to Russia. Yes, indeed, concentration and contagion risks are definitely major concerns to Russian banks, not only to Russian banks, also to Western European banks, but to a larger extent to Russia. And of course, it needs to be managed. I think most of the sort of rules and regulations are in place there. There's always room for improvement, in particular when we talk about contagion risks, sort of when one entity sort of influences the other one that is not exactly captured in the concentration risk measures. But apart from that, it's fairly fair and square. What I really wonder is when I sort of listen to the conversation and what has been published about, or the whole ecosystem discussion, is whether banks should move into like different types of business that is not to their core anymore, in order to mitigate these profitability dips that have been sort of talked about, and or whether it should be even forbidden by regulators, saying sort of there is a negative list of things that banks should not be doing. And I always come to the conclusion that in general, corporations, and that includes banks, should always be able to engage in those entrepreneurial activities in a free society that they think are beneficial to their shareholders and stakeholders, as long as they are legal and legitimate. But given, and now I'm coming to the question of regulation, given that many banks are also taking depositors' money, and there is a large information asymmetry to sort of your retail depositor, whether or not he knows the riskiness of the bank. So there is an instantaneous, I think, mandate task for the regulator to make sure that those additional put on the balance sheet type of risks are handled in a proper and adequate way. That should not be sort of castigized in the sense of being bad, but it should be handled properly. And it might be included in Pillar 1 type of RWA weights, but I'm absolutely with what Maxime was saying. This is a perfect example where and how the Pillar 2 framework could be used to sort of incorporate these type of risks as well, because it is, of course, a different type of risk profile if you're running sort of a Netflix, a cab company, or an ice cream shop, as compared to running a balance sheet and credit risk. So it needs to be fully incorporated in Pillar 2, maybe some backstops in Pillar 1, we believe. But it should definitely be both types of risk, concentration and contagion risk on the one hand side, and sort of the ecosystem type of risk on the other hand side need to be part of the overall risk governance framework internally, but also externally by regulators. Can I say whether concentration risk is more important than the ecosystem risk? Difficult to say, because it definitely varies from bank to bank, and that's once again is an indication that it needs to be taken into consideration. What is the individual bank's capital situation, balance sheet robustness, and where are they going towards to in terms of where their core banking business is vis-a-vis their strategic plans. So cannot really say whether the one or the other one is more important. I would say they are both important. They both need to be managed. And therefore, one thing is certain: both must be looked at in parallel. And as I said, Pillar 2 would be probably a good vehicle to use it, and with Pillar 1 being a backstop. But there is, and we have found that in Western Europe, and I don't know whether it would translate into the Russian market. And maybe one word of caution here when it comes to sort of enlarging the remit of banking activities. Bankers are super good balance sheet managers. They are super good credit risk managers. They are dealing in maturities, long versus short, what have you, liquidity and interest rate risk. And they've been doing that for almost centuries, if not decades. Regulators are also very well in tune with these type of risks and know how to handle them. And we are getting to terms with the new quote unquote non-financial risks as such. If banks once again invest into completely different risk profiles, then it needs to be made sure that both the banks as well as the regulators will be able to manage it and get a viewpoint on whether or not this is excessive risk or whether it's acceptable, in order to kind of calibrate this trade-off between sort of the stakeholders on the one hand side and the shareholders on the other hand side. I mean, this is not an old not a new discussion or problem. I mean, what we are talking about here is a discussion that we've seen in the industrial world for ever since it was sort of coming to fruition. It's the old discussion between complexity and diversification on the one hand side, or being set on sort of what you call your core competencies and lesser complexity on the other hand side. And I think it always needs to be balanced. And the trick question is, whether or not the individual participants are able to do so. If yes, then there is no reason to go into that direction. If no, if neither the bankers nor the regulators are able or willing to sort of observe and also control these type of risks that are coming from it, then maybe it would be a good discussion to think about banks just quote unquote providing finance and taking then obviously or swallow then the stick of lower profitability. But at the end of the day, it's a trade-off, it's a balance, it's a discussion. I think the worst would be to say there is only one risk that is important and the other is not being governed at all. So yep, both need to be looked at and both can be looked at. I wouldn't be overly negative or pessimistic there, given the forward-looking view that also Maxime was outlining, putting it into your SREP, ILAP, ICAP type of things. It's how it has been done in the past, and I think it could work for the future too.
Well, from what Maxime said, and thank you, Dirk, the banks have long been managing these risks. They have introduced their ICAP systems and similar approach. And tightening regulation, which could happen, will not have any dramatic impact. As we sometimes see on the part of the regulator, we don't have any time left. Just a couple of seconds to look at the poll results. Could you please bring them up on the screen so that we know the opinion of the audience? So you can see, far ahead are the risks related to non-core assets. Then you have concentration risks and the credit portfolio. And third come operational risks. And as we said, they include the new phenomena like cyber crimes, IT security. That's it. That's the triad risks that we'll have to deal with together with the banks, with their support, and with the support of the industry, including consultants and the risk management systems on both ends, both in the supervision and in regulation. I'd like to thank the panelists today for their insights. Thank you for sharing your views. Thank you for finding the time to join our debate and share your suggestions with the Russian audience, we, the banking community here in Russia. Thank you so much once again, and we wish you all success in fighting the risks, in managing the risks, and stay safe in these difficult times.